Check. Testing. Okay, we should be good. Should be live, guys. Can you hear me? Oh, yeah. That's better. Okay, let's get everybody back in here. What happened to the space? What the heck?
You're good. You're good. Yeah. I'm watching Spy and SPX right here. Daniel, I know that you have to pop off in a few minutes. One more time.
It's so weird. My its microphone was like not detected. And here's those weird things that happen. Let me get everybody back in here though. Hold on. Can everybody help me out real quick? Let's retweet this. Retweet. Get people back in here. Okay. Can people help? Can y'all post this link down in Discord and everything? Get everybody back in. Post it like the regular chat. Same here, hand, left side, earbud only. It's coming from the left speaker. That's, yeah, let me, it's probably set to mono. Oh, you know what? Let me do that. Thanks for letting me know. Audio mixing, microphone, mono, none. Copy left to right. There we go. This should be better. I had all of my, what's interesting is I had, my laptop, which is really state of the art. Like I have like the best laptop of the series. It's got all kind of nice bells and whistles on it. However, there's no mini jack input for audio, which is so odd because I had been using my laptop for filming my computer build video, which sadly is not finished because I still had to order a few more things. I had one thing that I was doing that I have to wait for something to come in from Amazon to finish up selling my laptop. I won't be finished till the end of this week. Does it sound good? Okay. It should be mixing to both speakers now. Make sure you guys tap that like button. Let's chit chat. Market is rational on the S&P. Let's get everybody here, and we will go over some first morning. Daddy got to wake up though. Whew. Tired. Long weekend. Okay, is it good? No, it was me. I had everything was set up for recording from this. So I have like this I built a second production studio upstairs. I probably sound echoey because I'm in my living room right now. And, but I had my lavalier mics plugged into my camera and had everything coming into my capture card. That I have USB that was plugged in my laptop. Cameras were recording. I was building a computer. It's a really cool video, I think. Well, it's my first computer build ever. It's cool because I'm in it, and Nicole's kind of in it, maybe. Oh, and let's watch what's going on with the S&P and Nasdaq group. A little bit of a move, but anyways, you know what really happened this morning? My computer was locking up, and we reset it, and it turns back on. Windows is like, Windows has scheduled an update today. We're looking to, you know what I mean? It's like Microsoft is just as bad as Apple. They force you to like buy a new phone when the batteries die, or when the new phones come out, they force the battery to die. Microsoft makes your computer run slow and shit just stops working just to force you to reboot, just to force the update. It's like update and restart. Okay, cool. ISM numbers just came out. Yep, let's pull those up really quick. So first thing you guys do every morning, and by the way, I'm live on the Good Morning FinTwit podcast. If you guys hear that chatter in the background, that's what that is. So the first thing we do every morning, let's kind of just give you a rundown, right? And so, I have a set of things that I keep open. Hold on. There we go. So when I open my browser, these 5 tabs show up every single time. And this is kind of how I get my trading stuff going. Let me get everyone back in here. Let's not repeat myself. So let's go. Let's get everybody back in here. 1 second. I'm gonna post in Discord. Okay, we have a new update today, which is good. Let's see what he said. Okay, so this morning, everybody, 5, 4, 3, 2, 1, smash that like button. I'm going to show you guys my morning routine. First and foremost, you make sure that if you want to do it, like I've saved this array of websites that I open up. I always have the Rocket Scooter cheat sheet, right? This is for our liquidity map from our algorithm. I always have that loaded up. Financial Juice is one of my favorite websites on the planet. It's a news aggregator that you can take any news feed that you follow. They're an awesome company. I met the owners of this company before they were even, like out the door with a lot of these features, and I've been a member ever since. What you do is on My News, you can pick anything you want to follow. Pick your favorite ones. And they have algorithms that go out there and search for all their posts, all their things, and you can aggregate whatever you want. Like you could pick all of them together. Mine have always been here. Like you can get Spot Gamma, Wall Street Journal, Yahoo Finance, Reuters, all of them. So I have Market Watch, Top Stories, Forex Live, Forbes, and some Bloomberg stuff. So essentially a news aggregator. It's like a Twitter style feed that has all the news in one place. And what's cool about these guys is they have algorithmic news parsing that will read stuff and determine if it's important or not. So anything that comes through red will give like a little alarm, woo, woo, and you can hear it from like across the room. You can put your Xbox controller down and run to your computer and see what the hell's going on. And so, during Jay Powell's commentary, hey, Tick Strike. So I actually tried it when it first came out. It's neat for what it's worth. I don't use it simply because I have my method that doesn't use it. So Tick Strike is a really neat thing. I don't even know if I have the sound turned on here, but essentially it's just something that they wrote, and it works on a lot of stuff. And I think it just makes, if I remember correctly, it makes a bunch of it makes sounds every time orders come through. So it also can alert you audibly that there's a lot of activity, like an unusual activity meter, which is kind of cool. I mean, it's a cool technology. They even have embeddable code that you can actually embed delayed versions of this on your own website or apps or things like that. Anyways, get your news here, and every morning you wake up and you read like the racks. So like what went on around the world. U.S. futures fell as yields increased. Yada, yada, yada. The reasons for that, you can read all that. Typically when inflation is going up, your fixed return on any kind of bond, right? So anything that has a fixed return, right? A bond, for instance, has at the maturity has a certain fixed value that you get. Inflation is a hole in that bucket. So the value of that goes down. So when inflation's going up, people want bonds less. So when the premium of the bond goes up, the yields go down. So right now, if bond yields are going up, it means premiums are going down because people aren't wanting those bonds. So yields increase because the value of the bond goes down because of inflationary concerns. Like it's like a bunch of, if you think of it, what's sort of like a double negatives, right? All this is saying is that because of inflation, concerns, people don't want the bonds. So when you don't want the bonds, yields go up, right, to attract people to it. So again, it's just noise. This week, market's opening with no real catalyst other than we had the ISM numbers, which you kind of look for here. So I use economic calendar on investing.com. This is just the little icebreaker so that we get everybody back in here because Daddy's mic went working for a little bit. So we're going to, let me get all this really clear. I like to come here and just set it to just United States only. I'm going to apply the filter. And then let's read the news. So today, so every morning, you come in, you read the wraps across the world. Make sure nothing is really important. Usually the first line or two would highlight important stuff. Anything that's really big, a catalyst would be like near the top. So nothing really big today, quiet day. Come to investing calendar and just look for the schedule, right? So you have everything that could or would come out today. These are the forecast, the actual. Nothing really today that is going to shock the market. The ISM manufacturing, employment, possibly. New orders, possibly. You know, these are different things. These all came out already. So when you think about it, it's like this. I'm pretending that it hasn't happened, but I'm like, okay, possibly. So then I come out and I look in the forecast and you just see what Wall Street's response is. I never really come through here and say, oh, it's good. Market should do that. I say, okay. The PMI is a number, and you can read. And what I like about investing, it'll give you a little detailed explanation of kind of what this is. This is just noise. Like, and I know when I say possibly because the ISM, while it does move the market, it's just relatively genuinely noisy. You'll have periods where it's really high, but most of the time you're hovering between 50 and 60 is great, is normal. And so anything below 50 on these ISM numbers are actually really bad. Just shows that the market and what this number is expansion in the sector, non-manufacturing sector, which in this environment you really kind of want the manufacturing one as well, which we don't have today. But again, it's not really a moving force today. So I go through here and I try to see what's going on in the news quickly. Just a quick read. Anything red pops up, no, okay, it's pass on. Read the first couple lines and the recaps. Okay, nothing. Look at the ISM. Yeah, sure, we had a number, but again, as long as it's above 50, it's not terrible. So there's no bad news coming through here. Then I go to the economic calendar. I try to see the earnings calendar to see what earnings we have today. I always sort by market cap. On market cap, we look today, there is really nothing. I try to look for pop stocks and things that people are really day traders are always into. None of these companies at whatsoever today are going to have any impact on the overall index. And I usually scoot through a couple of days just to see if there's anything big. We're talking about the, and we're at the tail end of earnings. So there's really nothing that's going to be, there's really nothing that's going to shock the market. I just look on that first page next couple of days. And so what I do is I open up all these tabs and then I make sure that I understand, if Costco's coming up, Oracle's still Thursday will be a big day. We love Costco. Lululemon. So there's you look for stocks that people typically trade because you're going to hear people talking a lot about them this week. Even your trading gurus and stuff out there will be talking about them. So really a light week on earnings. So really light week. There's not a lot. Then also going back to the calendar, you want to make sure that when you're looking at the whole week, you understand what's coming up in the week as well. Just looking through here, Redbook, maybe. So nothing I would say other than Thursday's jobless claims are going to be really what's important going forward. The continuing jobless claims, I believe, is not as important of a metric as the initial jobless claims, which is showing more near-term unemployment. These are people that get laid off and they file for unemployment within a month's time. And so, and this is in a week's time. So you get laid off. Well, actually, no. You get laid off for the first time during this week. So it means that you just got laid off and you just filed for unemployment. These are the numbers that we use for our thesis. And what it's to show is that as people are getting laid off and filing for unemployment, It's the signal that the FOMC is going to lighten their pressure on the market. When you lighten your pressure on the market, because the FOMC doesn't want to crash the stock market because people will get laid off again, and then we enter stagflation, which is this irreparable period of high inflation. So stagflation, if you guys are writing this down, is high inflation with high unemployment together. Right now we have inflation because everyone got laid off in COVID. The few brave workers that wanted to get back to work first, the only truck driver in town was like, oh yeah, you guys need truck driver? Okay, well I'm gonna charge you double for my service because I'm the brave one and everyone else wants to go home. I will do my job and risk whatever it is. I'll be brave. And so go out there and charge double, or she'll go out there and charge double. And then wages went up, right? And as people drifted back into work with wages up, that created the inflation we have. It's called cost push inflation. That's a specific type of inflation we deal with. So in that mode, as people are returning to work, inflation numbers should be coming down, which we've seen, right? We've seen that number tail down. And as the job market stabilizes, that's great. Now, companies are starting to trim 5 and 10% of their fat, which are people that aren't producing labor, which is improving their bottom line, and companies are going to be doing better going into this season's earnings and next season's earnings. As they're trimming their fat, this is what you're noticing. Companies aren't losing efficient labor. They're not getting rid of labor that's losing productivity. And how do you know that? Which is combining some of these reports together. Like, manufacturing PMI, and we look at these numbers and we talk about non-manufacturing sectors generally expanding if it's above 50%. So if the sector is expanding, and the index is based on indicators, which is business activity, new orders, employment, and supplier deliveries. It means basically people are getting laid off not because of companies losing business. People are getting laid off because people are becoming unnecessary for companies, right? And this is good for efficiency. So when the efficiency goes up, what happens to the stock price? The stock price goes up, which is the entire thesis of my pinned tweet. People start getting laid off, stock market is going to recover. And I call it the bad news is good news philosophy. You're trimming out people that aren't really doing anything but taking a salary, where you're saving hundreds of thousands of dollars a year per person as a company. You're going to have that money. Your free cash flow is always the major driving force for stocks to go up after earnings report, profitability and efficiency. So anyways, as the manufacturing sector is healthy, you can see that the layoffs aren't affecting productivity, which means you're saturating the labor force with people that need jobs now, and now you have an abundance of workers that need jobs. They no longer, the people are no longer, or jobs are no longer competing for people to come to the job. Workers are competing to get the job the other way around. So wages plunge, and then which means inflation plunges further. So all this talking point in the market is really bullish right now. Okay, everything is super bullish. You guys all understand that thesis? What's up? Hey, everybody, click that like button. I love you guys. So Emilio says I'm alive. Hell yeah. Matt, I love your platform. I started to play with 0 day to expiration. 0 DTE stands for 0 days to expiration. These are all or nothing options trades that you either lose everything or gain something. So they expire today or the day of. And so he's playing with credit spreads, which means you sell an option to pay for an option that you buy. And because of Liquidity Map, you can pick your strikes precisely, Normas. Well, that's amazing, because actually the first thing I ever learned to do with Liquidity Maps were selling vertical credit spreads. So that's awesome. So he sold a 405, 407 call spread against hedge pressure, and now 404, 406 against the barrel edge. So class, does anybody know what happens if you sell a vertical call spread and a vertical put spread? So 2 vertical spreads. Y'all know what that type of trade is called? Just a pop quiz. Okay, now let's get to Rock Zero. New release today. Let's go. Command of Trader is the last thing supporting the thesis. As you see, guys, this is one of the things to be cautionary. The market's not going to be screamingly bullish anymore, because as we see, yeah. When you talk about 2 credit spreads, you got iron condors. You're in the worlds of condors and butterflies. Okay, so here, when the green line and blue line, so these are your asset managers, the commandment traders of the S&P futures. When the green line and blue line are slipping down, market's illiquid. When they're pointing, or parallel, it's illiquid. When they're pointing together or pulling apart, it's liquid. Right now, it is illiquid to the bull side. You have people buying and people covering shorts at the same time. This is genuine buying. If you guys remember my tweet that was like, it will be genuine buying, right? This is how good we are at what we do. I'm going to tap and brush my shoulder here a little bit. This is it. When you look, let me pull this out really quick. Hey, there we go. I'm calling a bottom for 2022. This is a pin tweet from October and a rally through mid-Jan. Genuine buying, not just short squeeze, but genuine buying. I said buyers will step in, and then back in October, that's exactly what happened. The buyers stepped in. Look how good we are. We piece that together with fundamental analysis. We teach this fundamental analysis in Rocket Scooter. So if you guys have not joined Rocket Scooter, what's wrong with you? We're awesome, and our Discord is free. If you come, I promise you'll have a great time. I can't promise you'll learn anything. I'm kind of a doofus, but you'll have fun. And we listen to great music sometimes when there's music. So let me give you the link. Click this link really quick, everybody. Link's also in the bio. Go here, click it, join it. Free trial of our software, which I'm about to show. Blow your minds. Best algorithmic trading software in Houston, Texas, on this side of this room, probably that side of that room too. I think they're the best software, at least in this house so far. Could be the world. I don't know. I haven't really traveled much of the world, but I'm sure out there we're probably the best in other states and countries, and probably everywhere. Probably better than anything else that's out there. Maybe. I don't know. We'll see, but check it out. Free trial, 7 days, no credit card required. Hop in there and check it out. I'm about to show you the platform. Okay. Just FYI, there's genuine buying, and there are also people covering shorts. Market's illiquid to the upside. So market typically lowers. You typically lower price to look for buyers. So we have buyers here. So the market is just rallying on genuine buying, and this is exactly what we called. See the S&P up at 40.50 again is really good. It's really making my heart happy to say that back in October, literally right here, I said bottom is in. I pinned the tweet and we ran, right? So that's perfect. We love that. We love the idea that we can be the first people in the world to literally say this at this week and got it right, which is cool, right? How do we do this? This is all the fundamental stuff I talk about at the top. I know it seems boring. I don't like to listen to the news. I like to interpret what I see and try to predict the news before it happens, because as a trader, that's the difference between winning and losing. You see something people don't, and then you win if you're right. If you see something that everyone else sees, you are late, and over time you will make nothing. You will just be flat. Okay, so now we're looking at this. The dealers being no longer net positive is a hamper to the very bullish thesis and short squeeze theory. The dealers now have liquidated everything that we dumped to them over the last year, and now they're back to being negative. And we know that when the market makers are negative is when the market has room to free fall. So we're going to look at today's, so it doesn't mean it will, it just means that as you see, like even back here post-COVID, when they went negative, the market hovered for a little bit. And as long as there's genuine buyers, we will recover. So we might have a slow period for a week or two, and then we're back to long. It's back to going long. 4,500 at least by the middle of January. And I'm calling it again. So the genuine buyers are not being scared out. We might have a wave down if there is a little bit of selling, like tax loss harvesting and things. But other than that, market looks good. So we are irrational right now, which is why we're just kind of chit-chatting. NASDAQ falls to the bottom of the doomsday band. Let's double check that. The S&P is outside the band. You know, anytime you're outside the band, market is irrational. Let's get Russell right here. So irrational markets, we're going to be very cautionary, right? Russell did fall to the bottom of the band. We give you these band numbers. These are in our Discord. Our bot gives them to you. And you can see that they are very predictable, high volume pivots. One of the first things you do when you wake up is you check if the market's rational or irrational. Okay. So outside the band, irrational. You see the high volume pivot that's pivoting against. We at the very beginning of the day, you check this band. If you're outside the band, irrational, you sit out and wait for it to become stable to trade. The next thing you do is you come to the VIX. You make sure the VIX is not traded outside of this band, and you actually, instead of it being fixed, you just measure the total distance. VIX is clearly inside of this box right here. So that's pretty good. So both of those signs are rational. Things are nice. Do we have an index catalyst that's moved the market more than a risk interval? The answer is no. That's number 3. So that checks off pretty okay. And now let's get Rocket Scooter front and center. Let's double check. And we have a new release, ladies and gentlemen. 1 second. I'm going to talk on the podcast here real quick. I'm gonna run some stocks on the scanner. So irrational market, we're just chilling, right? We look for hedge pressure breaks as signal number 5. So the 5 irrational signals are 1, VX, I'll type them here, right? VX greater than 1 risk interval. And you guys can write down exactly what I'm typing right here just as a memory. Any of the index outside the doomsday band, index catalyst moves ES more than 1 risk interval, right? These are at HP, MHP breaks, and UVXY, call, wall, or bull zone. That's it. These 5 things will signal that the market is irrational and need to be cautionary. So we have no hedge pressure break. The only thing we're dealing with today is outside of the DD band. Last thing we're going to check is VIX. So it's it takes literally 10 seconds for you to know and determine the market's going to go nowhere or the market's going to be random. The market's random, you can react and trade that way. If people are selling condors or selling credit spreads. VIX is looking pretty good. Let me give a little recap here on the podcast. So everybody, feel free to tap the like button really quick while I'm about to go chit chat on this podcast and hang tight. So new features from Rocket Scooter today. You can now minimize the scanner. In the next couple of days, they're going to work on popping out the windows. You click the little chevron right here at the bottom. Now you got full screen charts. And then you can also open multiple instances to get multi-charts with that. We're also going to have the pop-out feature coming out soon. We also have some of the features of saving your chart layouts and loading your chart layouts. So you can save those and load those. It's partially complete. It's not saving them per ticker. We're going to change how it's done. So if I type in SPY and I save like a chart layout with a drawing and an indicator, every time I load up SPY, that layout is saved at the ticker level. And so that's one of the things we're going to get done in the next couple of days as well. But it's nice. So we're starting to save your drawings and save your indicators on your chart settings. You don't have to re-add them every day. Be sure you use the save feature. We're going to have an auto save feature coming on as well. That's what we released today. But that's awesome, right? So now that we think market's irrational, let's see if we can't find anything that looks good. SPY resilience is less than 0, which means half gap is going to be resistance. It's a gap down and go. Until resilience is greater than 0, the upside limit today is that white line. So the white line pivots the white line. Everybody see that? So at 405.4, the half gap, if this number is less than 0, which it is, then I expect half gap to be the resistance for today, which it is. Out the door, you hit a liquidity pocket and resilience is less than 0. And of course, right here, then I'm not betting on buying any dip. I'm doing nothing. Market's going to fall. It's irrational. It'll be random. So let me pull up some stuff. So now that the S&P is VRSU and irrational, I'm going to look for some stuff that are going to imply or predict that the market, or at least stocks that look like they can bounce. So I'm going to pick all the bull side ones. Okay. And then I'm also going to add above hedge pressure and above monthly hedge pressure. So ones that are just on bull side and looking pretty solid. And so with those, I'm going to look for stocks that are right on the side. Oracle's looking good. Pfizer's looking good. Bull long up at hedge pressure. We got some pretty good stuff. Um, 81.5 hedge pressure is looking really good. And then Pfizer looking good. JP Morgan looking good. GE looking good. So I'm looking for stocks that are right on the edge and looking like they could support, and also stocks on the swing side that are looking good to trade. Amazon, APA, CCL, Dow. These are ones that are bullish structure and also bouncing a monthly hedge. I'm just going to chime in with some data. We're looking at, give you guys some numbers. So today on the index, we have what we call a rational market flag at 4037 on the S&P. That's kind of halting anything I'm doing, but I'm waiting for the market to pop back in. We call it our Our risk interval, which is it's deviation the futures will have against the actual index. When the futures deviate too far from the index, the market can get unusual hedging and downward pressure. And the S&P is just now trying to pop back in, and it looks like it just now did. Our resilience number, which shows that the gap in the S&P is likely not to fill today. There's some limited upside, I think, but the market is looking to stabilize in general. And some stocks that popped up on our scanner this morning. We were looking at, we had Pfizer, Amazon, Home Depot, CCL. Let me pull up some of the other ones that were just looking like they want to move. Oracle, Walgreens, GE, T-Mobile. So like basically in JP Morgan. So a lot of stocks are looking pretty good. The market's dipping to find support. And there are a lot of genuine buyers here. We're looking at the commitment of traders this morning, which is a futures trader thing. And the commitment of traders is showing that there has been genuine buying for the last 2 months. Asset managers are stepping in and longing all the things. I think just getting on the books for this quarter as unemployment numbers are going up and they're trimming the fat, like laying off inefficient workers, bring up some cash flow is always the perfect mechanism for stocks to go up during earnings of more efficient companies. So I don't see any mechanism for the market to sell off until the at least this year or the end of the year. And stocks are falling to our calculations, what we call monthly hedge pressure, which is the rocket scooter version of your bull bear breakpoint. I mean, when you look at this thing, the market is positive gamma on monthly expiring options on the SPY, and all other places are holding theirs as well. So basically, when left to its own, if people just step away, like during the holidays, and the machines just tick over, all the hedging is going to be more long than short. There's not really anything that's coming out super bearish just yet. So the market is trying to fall because people are still bear-minded, but every time it dips, that committed traders are showing that there are people longing assets. So, I mean, it reflects the risk, even though it's futures, reflects the risk in the stock market. People are buying every opportunity they get. So just checking things out. I don't think anything's really scary, but I do like some people, there's a lot of people, especially in our stream, they're talking about they're trading condors, expecting the market to not be volatile, but also not really turn around and go anywhere really fast. And selling vertical credit spreads out of the money is a lot of what strategies friends of mine are employing very successfully in this time. So essentially, you're long some calls in case it breaks out, but you're just selling calls to bet that it's not going to turn around and have any big major catalysts until FOMC. And so I think that today SPY is going to be limited until 405. I don't think we're really going to go anywhere to the upside. And that's just kind of my take. We're not getting any strong bull signals, but we're not getting any nasty bear ones either. So to me, it's a sit out day on day trades. But other than those few stocks I named, those would be like for swings for the rest of the year. They're ones that are holding their monthly gamma levels. So that's going to be something I'm going to watch for kind of the medium term through the end of the year. But nothing is really catching my eye today as far as like a really volatile day trade.
Yeah, we're in major chop zone right here. I think that's kind of what you're hitting on. We've seen spike calls and puts both as value at the moment. I'm watching these UNH calls. These are looking good though.
So you guys heard me talking about on the podcast today selling vertical credit spreads. So where you buy a call and then you sell a call and pay for it. Will futures ever be a part of Rocket Scooter? When you say ever, at some point, futures will be part of the calculations very soon. Like within the first quarter, we will have futures data in the platform. But will you have futures data? That's something we don't know. Futures data is required to do the doomsday calculation. Futures data is required to do the risk interval calculation. It's required for other things. As far as will we have streaming futures data for you to watch futures, we have a solution for you already. You use the index ETFs that I show. So we have a conversion in our Discord. If you go there, there's a conversion channel that will show you. Even with futures data, you're not ever going to put futures on Rocket Scooter. It's just like a cosmetic formality. When the S&P pivots, like today off of 405, the futures will pivot. So the idea is that you're watching the SPY, and when the SPY gives you the alarm, then you trade the futures respectively. Does that make sense, LB? You don't need to see the futures data, or you have to pay for the futures data to get the same effect. Is a pocket between two call walls illiquid or liquid? Great question, Alan Gross. So a liquidity pocket is where bulls and bears are both in close proximity, and more willing to trade. Liquidity pocket, or LP, is when a bull zone is above a bear zone and you're right in the middle. That's what we call liquidity pocket. It's where people that are bulls are upside down and people that are bears are upside down. And in the middle, everyone's losing to the house, right? The house is winning. And so people are less likely to add to a position. They're more likely to escape a position. When people are panicking, they're more likely to escape rapidly. So liquidity pocket is this orientation. You can actually take a little screenshot or draw what I'm circling with my mouse right here. It's just bull zone above bear zone, 2 squares with a space between them. Liquidity pocket is right in the middle. And when you are at a liquidity pocket, the market has found balance for the day. When you're trading, you're looking for imbalance to find balance. Once you find balance, the market's not discernibly directional. The market is very random, and predictably, we've determined with statistics and back tests that when you touch a liquidity pocket, the market's 100% unpredictable at that point. Once the imbalance has found balance, market makers have found their groove. There's no reason for the market to spontaneously become imbalanced for no reason. So when you pass the liquidity pocket, we usually say the trading day is over. Now you can find specific things, but if you see SPY itself has passed through that pocket, it has now found its balance point. So there is no determinant that it's going to be directional. The minute you go through and touch this invisible, well, I guess where my mouse is, there's that little dash line that goes across the way. The minute you pass through that, the trading day is over. So we don't try to find day trades after you hit that or from the middle. You can find day trades against other pivots for other reasons, but if the market hits the middle, I'm not jumping in and longing this or shorting this from here. I need another reason to trade because the market has found balance. You can't decide how people that are upside down are going to escape their position, who's going to leave first, right? If you were to take a gamble on who's going to exit first, you take the fundamental gamble. And right now the fundamentals are very bullish. It just so happens that if I took the fundamental gamble, I still would have been wrong. So you can see how when you're after in liquidity pocket, market's just random. Market Scooter will tell you that the market's random, and that when it's random, you can decide to sit out, which is why right now the S&P is random, and I'm not really trying to make a determinant here of what's going to happen. I believe it's going to rally over the course of whatever time, but today there's no sign it's going to do anything. Once you touch liquidity pocket, market's found its balance. What do I interpret from today's ISM data? Any data right now that shows people are getting laid off, but as we are seeing in the last couple months of reports on employment, people are getting laid off, but the ISM numbers are not coming out showing that that is having any impact on productivity or the business of the non-manufacturing sectors, right? Now, we need to look at the manufacturing sector. I think that has more of a pull on the generalness of inflation, but I think the inflation narrative is finally dead. We are one of the first people in the world, in this trading world, to say that the inflation narrative was bogus. The inflation was not, even though Powell was mentioning it, Powell's secret motive that really, I guess really wasn't a secret because he said it every time he spoke, was really employment. Inflation was inflation was caused by people suddenly becoming unemployed during COVID and demanding high wages. The inflation was on the front end of production, not the tail end, right? There was a shortage of raw materials, there was a shortage of labor, and a shortage of transportation. All those chains and logistical bottlenecks in the chain created higher prices on the front end, which turned into higher prices on the back end. And then shortages of shipping made stores overcharge, right? All that stuff is going away naturally. And it went away because people got their jobs back and just started making things. It takes a while for you to get your raw material of whatever. It takes a while for that worker to come back and then make that thing and then ship it to the store. And then it takes a while for that to hit equilibrium where the store now has stuff on their shelves, no longer a shortage. We entered surplus mode like 3 to 6 months ago in almost all sectors of production. So you go to the store, there's no like shortages of bread. There's no shortages of video cards at your local electronics store. There's no shortage of diamond rings at Costco. I don't know. Everything's just kind of starting to like. Nicole's ears just perked up when I said that. She was like, "What?" Just kidding. There's no shortage of anything, right? Things are getting like very stable. So what we're looking for right now is signs of the real mechanism of what's going to push Powell's hand to act. and it's really going to be employment. If you have unemployment of people needing jobs that are good labor, right? Companies are laying people off and cutting their jobs, then you have a lot of people that could default on certain things, credit cards, mortgages, whatever. And right, so those defaults, Wall Street will particularly, if you get so many people get unemployed, two things are going to happen. Number one is you believe the Fed is going to be less aggressive, but then down the road further, you know that people are going to have a higher probability of not getting a job, and therefore credit's going to dry up. We might default on their mortgages. And we're only laying off a small percentage of people. So even if they all default, it's not going to really crash. There's people calling for like housing market crashes and stuff. There's not a lot of unemployed people or people on the fringe. We don't have adjustable rate mortgages that aren't kick in like in '07, where there's just going to be people having double their mortgage and not able to refi. All that stuff is still pretty healthy right now, even though interest rates are high. That the world's not like any dire straits to crash out. So when I see the ISM data, which is talking about the non-manufacturing sector, everything looks stable. So people are getting laid off, which you're seeing in other data, but you're not seeing a current impact in the ISM numbers. Now there's a little bit of a delay there, but it's above 50. So it's just showing that we're laying off people that weren't doing anything. I call them the watch Netflix from home, quiet quitters or whatever, people that are just like kind of showing up to a Zoom meeting in their pajamas and not really doing much for the company. You lay those guys off. The JOLTS numbers are coming down, which means not only are you laying people off, but you're laying them off and closing their job. So you're not laying them off and replacing them with somebody that's better. You're saturating the labor force with unproductive workers who are asking for more money than they deserve. And so they're not going to be able to go out there for ridiculous salaries, and that's the mechanism that's controlling inflation. So Powell's really just acting on driving the boat where you can lay off just enough people so companies can be efficient, but not enough that the company's price gets crashed or the stock price crashes. Therefore, more people get laid off, and then we have a big stagflation recession. So Powell's going to, I say like the metaphor is Powell got a new Lamborghini and he's accelerating as fast as he can until the steering wheel is like fucking shaking and like about to fall off and the car is becoming unstable. Then he's going to pull back, let it stabilize, and he's going to ramp up one more time to get interest rates up. And then really inflation is going to just be a reflection of employment. So with ISM being healthy, it's just showing that we're laying off people that aren't doing anything. So that's what it's showing me. The companies are going to be healthy going into next quarter's earnings. And that's really what you can take from this. So as far as its effect today, zero effect on the market today. And there's two ways you can say that. Number one is anytime you have a catalyst and the market moves and you return to that price it was before the catalyst happened. So here's the catalyst, right? 10 o'clock, the numbers came out. And right at exactly 10:26, and this is Central or Eastern time, you return to that initial price. So an event happens, the market tries to price in Wall Street's response to the event, and you return exactly to where you started. You pretend like that event never happened, and you no longer talk about it anymore. It's no longer impactful. So if Tesla stock was valued at 1,000, I'm just making up a number, and Elon says something and it dips to 900, it's bad news. But if it returns to 1,000 and just touches it one time, that news has zero impact. It's priced in. So the efficient market hypothesis, write this down. Efficient market hypothesis is a theory that states all information that exists, secret or not secret, is available to somebody and it's already been traded against. Therefore, the stock market already reflects all things at all times that are speculative, rumors, inside information, whatever. So if it exists, it's been traded. Yeah. So basically, the idea is if the market, hold on one second. Again, just repeating the hypothesis, it says all information that is public or non-public, i.e. all information that exists, has been traded against by somebody. It means that the market and communication is so efficient that if it exists, it's been traded against. So if somebody's secretly going to lay off 10% of their workforce, somebody out there will know that or have overheard that and leak that information. It will have been traded in. So the market is always pricing in everything in real time. That's really what it means. It means the market's pricing in everything in real time, even if it's not available to the public. Meaning that nothing theoretically should ever be a surprise. As the market becomes infinitely efficient, as efficiency approaches infinity, there is no surprises anymore in the market. And what that really just means is that if the S&P is at 403 before news comes out, and then the news comes out and there's volatility, but it returns to 403, it means it was already priced in before that event. So it's now called a non-event. What's up, Albert? Does that make sense, everybody? Spy, you need to refresh your platform, AJ and everyone else. Just hit F5. We had a new release, so you need to reload the new release. You might have, or your internet might be slow. It should change in real time. So if you're seeing a different liquidity map, just hit F5 and refresh. Everybody follow? So ideally, the ISM has no effect today. So this is, what do I interpret from today's ISM? I determine that the market is healthy, right? Fundamentally. So that's my fundamental thesis. People losing their jobs, but productivity is not coming down. So you laid off people that weren't worth anything. That's going to put a little bit of stress on other bigger things like credit and mortgages, just to repeat what I said earlier. But those things have a bigger delay before they start to take effect in the numbers. Imagine somebody now can't pay their mortgage and they can't get a job for 2 or 3 months. It's going to be a while before, numbers are shown that they're rushing to get out of their house and sell at any price they can. It's not going to reflect immediately. So layoffs of a magnitude of 5 or 10%, trimming the fat, is always bullish in the short term. It's fewer people spending money, which is slowing down the economy slightly on the immediate side. It's fewer people putting money into 401ks, which is also slowing down the growth of the stock market. But Wall Street and money managers see that as, this company is now going to save millions or tens or hundreds of millions of dollars a year, maybe, depending. And they're laying off people that really were just getting free paychecks and not adding to the company. So the company will be valuable next quarter. So let's get it on the books now, get the dividends, and then get the rally next quarter. Next quarter would be the reflection of this quarter's layoffs, which is why I said through January and quarter one, we're likely going to rally even further because we're laying off people. It's not affecting production. It's not affecting the manufacturing, non-manufacturing sectors. Does that make sense, everybody? So if you're laying people off and companies can still produce, then that company's earnings next quarter are going to be fucking stellar. Expectations will be great, and we'll probably even beat them. Right? With free cash flow, companies invest in themselves. They can do stock buybacks. They can do all kinds of stuff that they can increase their efficiency, invest in better things, and of course automation. As they're learning, they need fewer and fewer people. They can take the money they save and automate jobs and make it more efficient and increase production in the long haul. That's always bullish. Layoffs are always bullish when they're a little bit at a time. Layoffs are only bearish if the company is laying off people they need to survive and they're desperate. And so bearish layoffs always come after the market crashes. So the market tends to crash and then shareholders freak out and the market starts to recover. And then the company's on its last nail and it's like, okay, we're going to let off, 1 out of 6 people. That is bad, but that usually comes at the end of the recession. If you've ever traded a recession before, this is my second one, not including COVID. So we had, I've been trading since 2010. And back then it was the same thing. People will get laid off a little bit. But the big layoffs come after the market has hit the bottom and reversed. That's when they lay off. And of course, when that market crashed, people are getting laid off years later. I got laid off in 2010, like at the end of the summer. So, but the stock market was crashing in 2008, right? It's 2 years later and I'm finally getting laid off. That's how that happens. So you're not going to see in this environment when the S&P is just very barely down and inflation is caused by the result of COVID. There's really no mechanics out there that are showing that the market is not going, or the market's going to be super bearish. Now, the market might be on a slow roll, right? Houses are still priced high and interest rates are high. So you're not getting a lot of people going out there. If you're cautious in this environment about spending your money, there's not going to be a lot of, people taking out credit cards and spending out money on things they can't afford and things like that. People are going to be more cautious. And so if the market or economy grows from here, it's going to be slow. There will be some cycles the market will rally and sell off and rally and sell off. But as of last Thursday or whenever Powell was talking last week, his commentary is enough to end the recession. That comment alone could end the recession, because Wall Street is going to, efficient market theory hypothesis is going to say that if people believe that Powell's going to taper QT or be less aggressive on hikes, it doesn't matter if it has any impact on the economy or not. Wall Street's going to buy, because Wall Street sells when they raise rates. Wall Street buys when they don't raise rates as much. That's because you expect other traders to do it. And that's how it works. So Wall Street is just caring about that one mechanism. What is Powell going to do? And that's it. That's the only thing causing the sell-off. And that's the only thing that's going to cause the sell-off to end is FOMC. So none of the data is going to turn the market bearish from here. And all the bad news is likely to be good news. Because if the induced part or the recession is induced by Fed, then the Fed can just stop inducing it. And so if the news gets bad enough, they're going to stop. There's no mechanism other than preventing the stock market from crashing, which means once it recovers a year later, everyone will get laid off, right? Like it did in 2010. So Powell doesn't want to do that, because then they have to come in and bail us out with 100 times the risk, and we'll be in a bigger recession we want to escape. We just got out of a really big one, over 10 years ago. So, they don't want to immediately have to go back to quantitative easing, because that's the only way that they're going to be able to recover us and print money and bail us out. They clearly don't want to do that. So what they're doing is just depressuring the market a little at a time. Rate hikes are not going to stop. They're going to slow down, and we predict that. We'll get 50 basis points for the next 3 to 6 meetings. And then the summer, when the market's still not selling off, he's going to ramp up, and we might get 1, 2, 3% rates added on top of what we did. And that aggressive rate hike will come in the middle of a bull rally. It happened in 1982 to 1984. Same mechanism. You guys can go study that. The 80s recession had the same effect. We had 2 waves of rate hikes. They would raise rates, market sold off a little bit. They tapered off the rate hikes and slowed down for about 2 quarters, and then they aggressively raised them again. But the market was resilient and bullish enough to handle it, and it did not sell off in that second wave of rate hikes. I'm expecting exactly the same thing. As of last week, I'm almost about to pen a new tweet to say the bear market is 100% over. That's a bold statement, guys, but I'm almost there. Now, the mechanism is where we talked about the commitment of traders earlier today, is that it's negative on the dealer side. So the market's likely going to have a couple of waves of up and down before it gets running again. But I don't think we're going to go to all-time highs until after the summer of next year, minimum, if not 2 years out. But I think that people are going to price in the fact that layoffs are going to stop, companies are going to be more efficient, and there's really no bear thesis anymore. People are going back to work, making stuff, buying stuff, and interest rates are going up. But if people aren't getting laid off, they're going to be willing to take that risk and buy something with high interest rates. So I don't think that there's any bear mechanism anymore, period. The inflation isn't something the Fed's trying to taper. They're just trying to taper the liquidity they provided from QE. That's it. So the Fed is basically selling at the top, right? That's exactly what they're doing as traders. That's all they've done. So I think we're good. So Rocket Scooter has a couple of new features just to show you guys. Make sure you grab the free trial. Who here has not tried out our software yet? I'll give you a quickie little tutorial of what we're dealing with, and then we'll call it a morning. Irrational day, not a lot going on. I'm looking for the S&P to start moving. But really, we've hit that liquidity pocket, so there's really no mechanism for the market to move today anywhere. Do I think December will end higher or lower? Higher. I'm 100% certain that the market is not going to find lower lows this year. 100% certain. I was certain in October of that. Now, again, my certainty shouldn't affect your trading. Don't take this as trading advice, obviously. But my certainty is that there's no markets only crash when they're illiquid. Liquid markets do not crash. I can literally tattoo that to my forehead. Liquid markets do not crash. I used to scream that till I was hoarse, and liquid markets don't crash. The market is extremely liquid. Now, as of the last 3 weeks, it's become illiquid to the buy side, which illiquid to the buy side also doesn't crash markets. It may not rally the market because it's illiquid to the buy side, but it needs to be illiquid to the sell side with no buyer for the markets to lower, or for the market's prices to lower to find buyers. There is no illiquid to the sell side. On that commitment trader shows the market's illiquid to the buy. So it's a buying frenzy, which is preventing the market from crashing in this environment. Day one for your market scooter. Welcome back, Dietrich, man. Good to see you. Why is it irrational what failed the check? It was on, you tell me, you know the checks. It was irrational on DD break right here. But now it's back to normal. Everything's completely normal now. Form a directional bias day on liquidity map for that day. Then you wait on a certain level to break up or down, and buyer still calls it, and you're going to confirm long short position. I mean, that's a great way to trade. So let me show you guys some ways to trade. All right, rocket scooter liquidity map. Essentially, think of it like this: liquidity map is going to tell you what today is going to do, what range you're in, where it's going to bounce, where it's going to pivot. Right. So whether you're a day trader or a swing trader, you either are entering a brand new position today, or not entering a brand new position today, or you're adding to a position that you have to change your cost basis today. Like imagine if I was shorting the market and I woke up today and it hit hedge pressure and I still wanted to add to my short. I would add to my short because I'd expect it to pivot off of something there, right? I would have a positional bias, yes, a level that I want to act on, yes, and I'll decide if I want to add in my position or hold in my position based on what I can achieve with what I expect. So if today I expect the market to be random, I'm not going to act on a new position or change my existing positions. If I'm bull bias, which I form my bias off of a couple of things. Sentiment, number one, but number two is if the S&P is above monthly hedge pressure, I'm bullish and looking for bull trades. That's it. So I'm not bearish if the monthly hedge pressure is bullish structure, then I'm just waiting for a bull setup. So my bull setup today is only existing at a 405 break. But then I know that the 405 break likely hits 407 and has resistance. So the best I can hope for today, this market's extremely random. And if I break through here, it's going to hit the first resistance and sell off. So the market is capped inside of here today. With resilience being negative, it's actually less likely to go higher than that. So I have that the market is going to stay either below 405, or if I get lucky and it breaks, it's going to hit 407. What that means is I'm not going to chase a long today for a breakout. I'm also not going to short today because markets are relatively stable, right? So there's nothing, as you asked, Dimitri, 100%. So now I can say that there's, now maybe not the index. The index shows that it's random, and stocks in the index are going to be random. So I'm less likely to also come in and buy a stock on the day trade, right? Because the S&P I just showed you is likely not going to go anywhere, predictably go nowhere, which means it can go anywhere, but my planning says it's likely going to go nowhere. So now I need to go to find some stocks that I think are going to go in the direction I want. So if my bias is bullish, S&P's above monthly hedge pressure, everything is still bullish, let's find some bull opportunities. So I go to the scanner and I click all the ones that say bullish on liquidity map and I open it up. Then I want to add stocks that are greater than monthly hedge pressure and stocks that are greater than hedge pressure. So I want stocks that are on those actionable points, but on the bull side and not particularly random for a swing trade. And swing trading is where you're looking at monthly hedge pressure. That's kind of the go-to, monthly hedge, MHP. So swing trading is trading for more than one day at a time. You're holding for longer periods. You're not in, you're not out. You're betting on the thing moving for a multi-day run, right? So let's look at what's going on. And I have a list of stocks that the scanner's produced. And I can actually sort by which one's distance from monthly hedge pressure. It's in a bull setup. So all four of those setups I chose were bullish. So if you want a reminder, you go back to your liquidity map. I chose to look at all BLUs, BLDs, BSUs, and bear long ups. So all four of these are generally bullish setups. I'm looking for ones that are either on hedge or monthly hedge. So they're either going to be on one of those balance points. And then I can sort by where we are. So let's start with the ones that just generally are swing trade bullish. This is TLT. So this is the ETF for the 20-year Treasury notes. We learned this morning, yields are going up because Treasury notes are declining. So this is if the TLT is breaking out to the upside, that's great, right? People are buying the dip in treasuries, which is interesting, which will drive yields down. When inflation comes down, people go in and buy treasury bonds. And you're seeing that we're getting a nice little attempt to crash out, and all of a sudden treasury bonds are recovering. That's a telltale sign inflation's coming down. So a thing to write down if you guys are taking notes. When inflation goes up, people don't want bonds. Over the term, they think we're going to be inflating. So if the inflation is going to last 1 to 2 years, People won't want 1 to 2 years worth of maturity on their bonds or their whatever fixed yield you get, fixed income, right? So clearly with inflation numbers coming down, right, people becoming unemployed is going to drive bond prices up. It's really weird to think of it like that, but that's exactly what's happening. People are unemployed, wages will come down, inflation will come down. Therefore, a fixed income in a bearish environment is very much more palatable when the things, because remember, if you say if you get like a savings bond from your grandma for your birthday, it's like $50 savings bond. You pay $25 for it, and in 7 years, it's worth $50. How about that? You gain $25 for free. But what if the dollar lost $30 worth of value? You gained 25 and you lost 5. Your grandma paid 20 and you effectively 25 and you effectively sold it for $20, right? Because of inflation. So you actually lost money on that deal. Inflation will destroy the value of a fixed yield or fixed income return. Yield is a percent that you get, and inflation is devaluation of that fixed amount of dollars. So, it's a whole metaphor, like you buy a loaf of bread for $1 when your parents are kids, and now you pay $5. But effectively, if somebody used to make $1 an hour, then that was 1 hour worth of work buying a loaf of bread. If bread is $5 now, but you make $10 an hour, the price of bread, even though it went up from $1 to $5, actually went down half, because it's now 30 minutes worth of work that buys a loaf of bread instead of an hour. So inflation works on how labor translates into purchasing power. And we're dealing with a place where people were just being paid a lot more because work was scarce, not because the value of their labor was worth something. How do we know that? Because these surf Reddit from home and still get $200,000 your paycheck just got fired, right? So that's showing you that people are getting paid more than they deserve. So in this environment, treasuries will look great. But anyways, my fundamental thesis is like, okay, right? People are going to buy treasuries. TLT is looking also good because monthly hedge pressure is supporting. So I had a fundamental thesis believing something. I get the signal that something tried to sell off on the monthly scale, which goes to December 16th, and is now holding the fort. This is an entry signal for TLT. It's a bull long down. It's holding monthly hedge pressure. I can have a stop probably at 104.5, maybe 1 point lower in case it breaks out and crashes. But in general, I think that's a great sign for finishing off the year and seeing treasury products start to stabilize. As you see, over the course of COVID, because of inflation, people don't want treasury notes. And this is certainly good. As long as inflation's coming down, these things are going to go up. And now I'm going to look for the sign that, is it actually going up? So this is just an example. I'm not telling you guys to trade this. I'm just showing the example of somebody asks a question, how these things work. So does that make sense, Dimitri? I have a fundamental understanding of what I think will happen. Then this TLT is different than a stock because it's going to be related to the treasuries. But if you look at what you see, it's holding monthly hedge pressure, which means for the course of the month, it's still not bearish. So I'd make a fundamental thing like that. So let's pull up a stock. Look, Walmart just popped up on the scanner. It's a bear long up. It's at monthly hedge pressure. And I'll say, okay, if we load up Walmart, it's the same thing. What's my fundamental thesis of Walmart? Is Walmart going to be doing great, or is it going to be doing bad in this environment? And what happened? Well, Walmart's been selling off, and now it's found a support. If I wanted to swing trade Walmart, I would enter a swing trade right now for at least a month out. I'd have a stop 1 strike below, so I'd probably stop right down here. And now I've got a great position to go forward. Now I know that with Liquidity Map today, the resistance is likely that bear side, so I know that I'm not going to, if I buy Walmart here and it rallies there, I'm not going to add to my position there because I know it's going to taper off and I might get lower. So bear resistance just tells me today that the market is, or Walmart is likely trapped inside of here. If I did want a long opportunity, this was it. And that's how I use Liquidity Map for a swing trade. For a day trade, it's the same thing. You break through the bear side, and if you want to short, you short to that resistance and cover your trade and your day's over. In a flat environment like this that's non-volatile, you just bet that you go to the next resistance and you're done. This is a long entry for Walmart for a day trade as well, from here to there. It's a very good run. This is 50 and a quarter, 51 and a quarter. So you can rally 1 and a quarter at the 1 point stop. It's 1.25 to 1 trades. Square them 1 to 1. It's a great one to take. So that's how I think. Airbnb just popped up on the scanner. It's a bull long down. So I'm looking for stocks that are hitting monthly hedge pressure and supporting for long entries. Does that make sense? Matt B says to go to the upside prior to the Fed pivot. However, that said, history has showed us that the largest decline equity market always comes after the Fed pivot. Yeah. Well, it's because the Fed is not causing people to react because of the Fed announcement being a surprise. It's because people that are in a position and want to exit a position are waiting for the volatility from the Fed and the IV that's built into options to act and sell their premium on options or get out of their stocks at that time. If a fund was long and wants to take profit for the end of the year, they will wait until that day likely to do it because they know that day is a 50-50 shot. You either get a big rally or a big sell-off. They go in there and put really tight stops in, and then they go in there and just dump their stocks when it rallies. So it's not, you're right, Matt B. So the idea is that nobody that's really smart with a quant firm that does the research is going to ever be surprised by the Fed's actions. The Fed's actions are almost 100% predictable. Fed's going to raise 50 basis points this time, and I'm just some schmuck sitting in my living room and my boxers trading. And I'm 95% sure that's going to happen. So it's not like that number shocks people that are smarter and faster than me. They know it. That's the day they decide to take action. If they wanted to sell, they already want to sell today. They know I'm going to sell and we're going to get out on Fed day. If people want to buy, they're like, ooh, I want to buy. I'm going to buy on Fed day no matter what because you're going to get volatility. So as soon as those options crash, right, after that premium ducks sell those options, people are going to dive in right after that event happens and gobble up cheap options, right? Nobody's going to act by buying puts and calls as IV is building into them leading up to a major event. So that's why you see what you see. It's not, oh my God, it's 50 basis points. Is that bullish or bearish? Wall Street has already made their decision a month before that. You follow? Nobody is going to be like, oh shit, that's a surprise. Let's go. Now the surprise would be if they raise 1.25 basis point when you think it's going to be 50. Then people will change their mind and you'll have a very, very, very volatile move. But the idea the VIX is trading lower, people are not scared of what's going to happen. Lower VIX means market's predictable. It means people are all on the same page as what's going to happen. And you've been seeing that, right? Higher VIX means people are scattering their options, which would artificially raise the premium and, of course, raise the IV. So leading into FOMC coming up, market's not worried at all, right? So it's just the event that creates the volatility that lets people sell. Imagine that you are selling options or buying options, and the moment before the event happens is the highest premium you'll get if the market goes nowhere. People are going to start selling their options seconds before that event. And then right after the event happens, people can dump their position. So that's basically why you see the largest decline or rally comes after FOMC, because FOMC is the trigger, right? Yeah. And this is for everybody. I know you get it. So you swing off of MHP and hold as long as it holds. Yeah, and every day I wait and I will recalculate where that MHP is with Rocket Scooter, and then I'll continue to long or stay long. Yeah, so Dimitri, we have a process called monthly maps. It's a brand new thing that'll be coming out in the next 2 weeks or less. Monthly map will be a feature that will show you how to pick a time and a price. It is revolutionary what we've invented. There's nothing in the world like it. It's an options trade planner that will help you pick your price and your expiration. We teach a lesson on it, so I recommend you go into the free trial, or at least buy the sub while the Black Friday special is there. We have half price for our software. It's $100 a month. Literally the cost of a couple books, or if it's a steakhouse read the other night, like 3 cocktails. So, you can't go wrong with a month of education, and we'll teach you monthly maps. It is how I plan all my option swings. And everyone I show it to that's an options trader goes, what the hell? How did you do this? This is pretty cool. This is something I've always wanted. When do I pick my expirations? That's what monthly map will help you with. So Matt B, what's up? So to go to the upside prior to the Fed pivot, however, that's a history showed us that the largest decline always comes after the Fed pivot. So what were you saying? What are your thoughts on this? Mike Wilson from Morgan Stanley also agrees with you that we're rallying through Q1. However, with inflation coming down, it will negatively affect companies' margins, even with layoffs. Yes, and you were 100% right, Matt. I 100% agree. the earnings, or if you're going to A/B comparison, the two things in earnings that matter, it's going to be free cash flow versus margins. Okay. So companies will have free cash flow to increase their efficiency, which will be bullish in the short term. Margins, which would be the other side. Inflation is helping profits because of margins, yes, but think about it like this, right? Oil companies. Right. So you're 100% right. So the seesaw effect is margins versus the perception of increased cash flow efficiency. You nailed it, dude. They're the two things that matter. So if a company bought something at $50 and could sell it at 60 because of inflation, then that looks good on paper, right? They made $10. But if they bought it at 50 and can only sell it at 50 because inflation's coming down, then they didn't make any money. But if they laid off enough people, they saved money. So it's those are the two things that are be battling in Q1 for earnings. I 100% agree with you. So when the things come out, you're not going to be looking at sales. You're going to be looking at margins, and you're going to be looking at people's reflection of that. Now, lower margins is a reflection of what we have now, but the increased efficiency can lower the cost of raw materials and increase the margin. So increased efficiency or laying people off will increase the margins. Inflation coming down will decrease them, and you nailed both sides. And that is exactly what you look for at earnings. And so they both have delayed effects. Raw materials, and right, that's it. And I think that you nailed it, because that's exactly what you have to see. And when we get to there, I think the perception is that inflation coming down on a general sense is going to add one more effect to the stock market besides. So if you look at every company, that's the battle during earnings season in Q1, right? Margins versus efficiency. Company saved $20 million this year on firing people, but margins came down 25 million because of inflation coming down on paper. So it looks like the company is at a net loss of 5 million, right? But the added bonus that comes to that is inflation's coming down. Next quarter, the Fed is less likely to raise rates further. So Wall Street will perceive bad news as good news anyways. Because the next step is, okay, the company's margins are down, but the Fed is likely not going to be so aggressive next time. Which would you rather do? And if you're a firm that has a 3-month outlook, you're likely to long the stuff knowing that the margins will improve within 2 or 3 quarters with the added efficiency, as long as the Fed doesn't do anything aggressive. So Wall Street will likely perceive bad news in margins that's slightly competitive with the efficiency as probably good news, as bad news is being seen as good news, since the Fed is inducing stuff. And it's really hard to guess how people will respond. I think right now, my thought is the only bear mechanism that I can see is a very big company filing for bankruptcy. I don't see any trigger or a surprise rate hike of greater than 1.5 or something like that. I think likely would be a trigger that surprises and shocks Wall Street. Right now, I think people that are buying stocks are just going to buy and hold for years. The most bullish people right now think the recession is over as of last week, like completely over. So there are people that are willing to hold through it. And there's not a lot of bad news that can come through that's forecastable now. All data is looking like it's improving. The bad news would have to be a surprise. So it's hard to predict what that surprise would be. So what's the scenario that keeps the bear market alive? That's exactly what I'm saying. If you had to choose, if the inflation ramping back up, the inflation will not ramp back up because there's no mechanism for it anymore. Inflation is actually going to plunge from here because people are getting laid off, and we're saturating the labor market with people who are inefficient, who are going to not only have a hard time finding a job, they're the worst at their job. So they're out there going to work for pennies on the dollar just so they don't go bankrupt, right, themselves. So with that being said, wages are about to plunge, right? And so that mechanism is really good. So the inflation story ramping back up, I think the inflation story, as it was created because of, COVID induced the inflation on the front end, you'd have to have global shortages in raw materials again, global shortages in labor, global shortages in transportation, and all those sectors look healthy right now. commodities prices are stabilizing. Oil's come down. Everything's coming down because of supply. So you need a shortage again to draw that inflation. Or the other side of the coin would be your normal inflation of hyper-economic activity, which would cause the Fed to raise rates aggressively. That's not going to come for at least a year when the market's going to skedaddle really quick higher. So as far as what is a bear market alive data point would be a shock. So the FOMC, if we expect a rate hike to be less or a rate hike to be the same, and it obviously comes in more aggressive, that'll be knee-jerk bearish. If a company lays off 20% or 30%, a big name company, like a big tech company, that's big. Like it'll be surprise effects, and then it'll have to be things like that in earnings season. So right now people are saying, okay, let's look at earnings to see what Wall Street perceives of all this data. There's a stabilization process coming on. Layoffs are bullish to a point, and then they're bearish. But companies won't lay off people unless there's pressure from the shareholders to do so. And when the stock market's stable, I don't see the 20, 30, 40% layoff from a company like Microsoft coming anytime soon, right? So the market would have to crash first to create the dynamics for the bear market to return. Right now, it's just a liquidity thing. So I think everything is just, I can't see a scenario where the bear market returns just yet. It would be negative earnings, Matt, and I think that you nailed it. Margins are down, and margins are down for a second quarter and a third quarter. Wall Street will likely pivot the other way and say, ooh, the economy is not doing well. And then, of course, what's happening with inflation coming down is treasuries and fixed yield will become more palatable. So people will be less likely to buy stocks that are going nowhere and more likely to buy fixed income, right? So I think that's what we'll deal with, is the competition between what to invest in. With inflation coming down, your dollar stretches farther, and so now you're more willing to invest in something. It'll be, what is that something that's more appropriate. So remember, when inflation comes down or goes up, people will get in or get out of treasuries. The treasury notes have been plunging for 2 years, and I believe they're bottom for forever. I think this is the bottom. So fixed income is going to be something people are going to pile into indirectly, proportional to getting out of equities. If the margins are bad and companies looking bad, and because inflation's coming down, right, the margins are bad, well, guess where Wall Street's going to put their money? Right into fixed income. You're going to see the treasuries turn around, right? Either way, something is going to be bullish because inflation's coming down. When your purchasing power is really good, you're going to buy something. Cash is no longer going to be king. So it's going to be the competition between, I think, fixed income and equities, right? And I think futures or commodities trades are not going to be aggressively bullish because inflation is what made those things priced so high. Inflation coming down, it's not, oil prices aren't going to surge again. You'll need some geopolitical event for commodities prices to go up. There's no shortage, transportation's better. So all of that stuff is stabilizing. And I think as things stabilize, prices are to come down. And I just think that overall the economy is going to grow from here. Yields come down when inflation goes up, yields go up because bond prices come down. When people don't want to buy a bond, yields go up. So yields are going to come down when inflation comes down, just like you said, yeah. But that's not because people don't want the bonds, it's because people are buying the bonds. So while yields are coming down, they're slightly coming down. They're not coming down that much. Is that what Mike said from Morgan Stanley? Really? I actually never, maybe I'll follow on Twitter. Everything I'm saying right now is just my own thoughts. So I'd like to read what other people say. I really don't, I'll be honest with you guys, I don't read a lot of news, do I? I literally wake up, get out of bed, and come down, and I just formulate my own opinions. And I like it when other people come up with a similar idea because it makes me feel not so stupid. Yeah, and it's good that you don't, because their job is to find that opinion before it happens, right? Okay, so back to Rocket Scooter, right? I was looking for some plays. This is how I find them. And of course, we'll do like a session. I'll be back on the main live stream with my camera, like basically next Monday. I'm going out of town on Wednesday to a baby shower. And then I'll be back. My computer will be super sweet. We're going to have guests on the show. It's a whole new thing for us. You're going to see Rocket Scooter everywhere next week. We're going to be doing so many things. You guys are going to love it. So get in now into the Discord while you can to follow all the news and the events. Other than Inverse Kramer, oh hell yeah. Yeah, Matt B, it's good chatting with you. Are you the same Matt B from back in the day that's always been around, or are you a different Matt B? Because I had a Matt B friend from back in the day. Yes, here's homework for you guys today. I'm going to get out of here. Yeah, it's the same Matt. How have you been, dude? I missed you, man. I missed your smartness. I don't ever forget anybody. Yeah, I'll give you guys a video to watch. I want you guys to watch these three videos. These 4 videos. I keep adding to it, but I promise, watch them. These are the videos you need to watch. Pre-market strategy. Watch them in this order. This is my pre-market strategy. It's like how I set up for
you know what
literally,
is real.
literally 10 seconds.
The magic's in you.
How I do all the irrational checks. And these are the irrational checks in this second video.
Our main focus of our...
And where I get all the data from. So these 2 videos, it's like 15 minutes of your life will change your trading style overnight. You'll be like, I didn't know you could do this. You watch this, you will be very impressed, I promise. This is how I pick my profit targets. So when I long something or short something, that's where those are the 4 strats I use to, where do I long to, where do I short to? And then the golden setup is the perfect setup. This is a longer video, but the golden setup video, this is the most important video we have so far, goes over every strategy we have and how, when everything lines up, the market's entirely predictable. So that's basically, those 4 videos are about an hour and a half worth of your life. And you will watch them, they're free. At the end of the video, you will very much think differently about stock market, I promise. Okay, everybody go to the Discord, link in the bio. I'm going to drop it for you here. Or link in the description, sorry. I'm going to drop it for you here. Go to the Discord. Discord is free. Get the free trial of the software at rockzero.com. There is no credit card required. You literally have no downside to checking it out. You can play along with us tomorrow. Let's go here. Check this out. If you want to take the plunge, Black Friday monthly is half price off for the rest of your life. With all new features and data feeds come out, you won't have to pay for them. Those of you that are futures traders, like, will you get futures data? Futures data will be required for some of our calculations, but you don't need futures data in your platform. You'll have to pay for it, and you guys don't want to pay for that. We'll teach you how to do rocket scooter pivots if you are a futures trader, and I use ETFs to do that because somebody had asked it earlier. So if you trade oil, we use USO. If you trade VIX, we use UDXY, etc., etc. Okay, love you guys. See you later. Go to the Discord, and we'll check you out tomorrow. Bye.